All right, thanks for joining us. We're on Talk to Talk with Tribe Title. Today's guest is Vic Bals of USA Mortgage. Thanks for coming on, Vic.
Hey, thank you, man. It is a beautiful day here in Detroit in this fall weather, like almost springish like weather. It's going to be almost 70 degrees today.
I know, it's crazy. I'm sure that'll go away soon enough.
Yep, absolutely.
So just wanted to get you on the show and talk to you, pick your brain a little bit. So I'm probably as guilty as the next person. When I first got into this business, I thought of a mortgage lender is a mortgage lender is a mortgage lender. From talking to you, from sitting in some of your trainings and things like that, I realized there's a huge difference in who you decide to partner with. Could you tell us a little bit about what the big differences are?
Well, lenders, experience. I've been doing this 22 years. I'm an engineer by trade, so I think of things very analytically, and it's not if someone can buy a house, it's when someone could buy a house. So they really just got to prepare. And, I was taught at a very early age is never sell, you have to educate. And what I find is people who don't make decisions, it's because of a lack of knowledge. And they actually use that to justify not making a move, like in like the current environment. Right now, we are in a current higher rate environment, a higher interest rate environment, which is still pretty good. I mean, rates are about 7.25%. They're about where they were in 1998, and interest rates, of course, in the pandemic years were down to actually under 3%. So a lot of people are stating, well, I'm not going to make a move because I'm waiting for rates to come down. Oh my God, inflation is high. The market's going to crash. I'm not going to make a move until it crashes. Right. I'm not going to make a move until values come down. I'm not going to make a move until the election.
Yeah.
Right. And I find that most of that is really a justification not to do something. So they can wake up in the morning and say, well, I'm waiting for the market to crash. I don't need to make nothing. I don't need to make a decision. So, I see that all the time. But as when we sit with a client and break down and actually show the statistics there that the market is not going to crash, rates are inevitably going to come down, and they start to get a feel, they start to lower their shoulders and say, okay, so what do I got to do for home ownership?
Right. No, that makes a ton of sense. I like what you said there, educate instead of sell, because it seems like educating, you're going to decide that you need to do this anyway. This is something you should have. Whereas selling, if you're selling somebody something, it's probably something they don't need.
Absolutely. And what I don't like is, the media. Everybody tends to try to go online and learn all they can, right? But let's say you had a heart problem. Would you go online and figure out how to do heart surgery?
Right.
No. Are you going to go to a general doctor? No. You're going to go to a heart surgeon, a specialist. And that's what I do, and that's what we do at our office. You have to become a specialty, because it's not just come out of the box, get me a mortgage, because everybody's credit score is different or unique. Everybody's employment situation is unique. Everybody's personal situation is unique. And so, and I've used this analogy many times, but a mortgage is really like a hamburger, right? It's like you're going to McDonald's and it's an assembly line, right? It goes through this process here, this process here, this process here. But when you do a mortgage, everybody, yes, you're getting a hamburger, but this particular person may want extra lettuce, no pickles, and you want a toasted bun. Okay, so we have to design it to meet those needs.
Right.
But yes, every mortgage still goes through the same processes, but we have to design that mortgage to meet everybody's unique situation, because most people are conscious about, they are payment conscious, they are cash to close conscious, they are rate conscious.
Right. What I like about you too is that I've had a couple of conversations with you where you're not just, here's the deal. I can get you a mortgage. I'll look at your credit. I'll do this. Yep. You can actually tailor things. And I'm guessing this is probably from the engineering background, but you can tailor things to what somebody's trying to do. Like I came to you and I said, look, I'm trying to do an investment property. This is my goal. And you said, you can do this, 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 and this. And these are the things you need to do to get to where you want to be. And these are the implications and these are the upsides. So you really knew everything about it, which Most people don't. They would just say, this is what you need to get the mortgage, and then you figure it out on your own.
Absolutely, absolutely. Because in your case, buying an investment property, there's 11 ways to skin a cat here.
Right.
And we have to look at, what is your cash to close conscious? What is your payment conscious? Are you trying to cash flow this thing? We're looking at the appreciation. We're looking at the depreciation, tax write-offs, so you limit your tax liability. So there's a lot that goes into everything.
Yeah.
You just don't go out there and buy a house.
Yeah, which is cool. And I've told everybody that'll listen, after that conversation, like, go to Vic if you're looking to do anything investment-wise. I'm like, he knows the ins and outs. He'll tell you exactly what you need to do and steer you in the right direction.
Well, and it's not necessarily go to Vic. Go to other loan officers too, and then come see Vic.
Right.
Because you need to explore and discover some of the analytical type thinking that other loan officers have to offer. So when you do come in and peel the onion, you're going to see the benefit of that. You know, I often get many times like, oh my God, I've never learned so much in an hour sitting with me, you know, going over something that they did in 5 years of research on the internet, or listening to Barstool Billy because their friend got a mortgage.
Yeah, or they read something. I just read something the other day that actually said that the weird thing about our society now is people go online, they see one thing or read one article, and it's not an opinion, it becomes fact. You know, that's the fact, and they stand behind it, and they'll fight to the death over it. And it's literally, they read one thing from one person. You know, one of the common myths is people still feel very adamant that they have to put 20% down to buy a home, and that is just not the case. And that's the father syndrome, okay? Because they're listening to their parents or listen to Barstool Billy and say, oh, you need to put 20% down to avoid PMI, private mortgage insurance, because that is the devil. Right. No. It is not the devil. It is a tool in a toolbox, and my job is to teach or educate one how to become a journeyman, a craftsman, and how to use what tool under what situation. And when we were all kids, you know, you went to Grandpa's house and went for a visit, and he had this toolbox, and you look in there and you go, what's that thingamajigger right there? Right. And you never understood what that thingamajigger was. And you inherited it when Grandpa died, and then one day you're doing some particular job around the house, and you go, I need that thingamajigger. Yeah. That's what that thingamajigger did. Right. You know, so that's one of the tools in the toolbox. So by sitting down and meeting with clients, we go on a discovery mission, you know, and I want to understand not just, I want to buy a house, but what are the underlying elements? What's driving you psychology-wise, you know, and what are your hot spots, your cold spots? Are you going to live in the home 1 to 3 years, 3 to 5, 5 to 10, you know, or is this the forever home? Because each one of those objectives drive a different solution or, you know, a method of how we're going to get there. Yeah, which, like you said, that you seem to have a lot of tools in your toolbox. I heard one time somebody said, if somebody just has a hammer, everything looks like a nail. You know, because they have one solution for everything. Whereas with you, the experience is what gives you a lot of different tools and the knowledge on how to use them. Right. Well, I'm actually a journeyman tool and die maker by trade. So, are you really? Yes. So, I know how to break it down and use multiple tools. So that's where that knowledge and, you know, that problem solving tends to come in. Plus, I eat it for breakfast. I just love sitting down and creating something there, you know. And but people are funny. You know, they'll come in and say, you know, or I'll get a phone call and someone will say, hey, what's your rate on a 30-year fixed? I go, and I'll say, okay, well, what rate do you want? And they go, what do you mean? So that throws them off right there. Right. I want the lowest rate in the world, you know, and I say, okay. How would you like 2%? They said, yeah, I'll take it. And I go, okay. Well, in that program there, we're amortized only over 4 years. Your payment's $9,000 a month. And they say, well, no. I can't afford that. That's too much. I go, I thought you were rate conscious. So you're payment conscious. And they said, well, yeah, I guess I am, you know. So I'll turn around and say, well, I tell you what, how about I do this? Let's give you an interest rate at 10%. We're going to amortize that loan over 87 years. You will never pay it down, but yet you will gain the appreciation over time. Yeah. And your payment's $600 a month. And they'll say, really? Yeah, I would be interested. I'd say, well, sorry, we don't have that program. I just want to see, are you payment conscious or are you rate conscious?
And then they say, well, I'm also cash to close conscious, and I'm payment conscious. I say, okay, well, if you want that lower payment, all you got to do is bring $80,000 to the table.
Yeah.
There, problem solved. Now you're paying. Well, I can't do that. I don't have that. Oh, so are you cash conscious, rate conscious, or payment conscious? And they go, okay, I don't really know. I go, well, let's look at objective conscious. Do you want to get a new roof over your head? They said, yes. I go, okay, because if you said no, rate conscious, payment conscious, or cash to close conscious doesn't even come into the picture.
Right.
So first we need to determine, are you objective conscious? I want to get a roof over my head, right? How much cash do you have to play with? Where is your where's your comfort level on a payment? Right. Let's not worry about rate, because rate is the only thing I can't control, because I can't control the market.
Right.
What we are going to do is shuffle all the tools that we have meeting your objectives to get you home ownership in any rate environment. We do expect rates to drop here very soon. So we will marry the home. We will date the loan.
Right.
In meaning, we will treat that home like a 401k. Most people have a 401k. And at times, they will rebalance their portfolio because they have too heavy of a mix in a particular investment. Okay? So when we buy that home, we're going to treat that like a 401k. And most likely, that 401k, that new investment, that home, that new retirement vehicle will probably outperform any current 401k you have with your employer there. So as we get into that home, and over the years, if rates come down, we will rebalance your portfolio if it will benefit you. Okay. If you have a life-changing event and we need to extract equity out of that home, we will rebalance your portfolio. So treat the home like a 401k, marry that home, date the loan, and rebalance your portfolio as needed.
Yeah.
To any current market condition.
Makes perfect sense. And I'd imagine that conversation probably puts them back on their heels a little bit, but then they go like, holy shit, I got in the cage with a lion here and I'm a house cat. Like, this guy knows what he's talking about. I should probably listen.
Well, what I do see is people, they take the cotton out of the ears and they start to put it in their mouth and they start to listen.
Right.
And it's very interesting. So I'll pull up some arts and charts there and show them where the market's going, and then I get the objection handler. Well, the market's going to crash, That is not the fact, man. The average first-time home buyer in this country is 33 years old. We have 5.2 million of them each year entering the market, okay? We are only building about 1.6 million homes in this country every year. So we're still 3.5 to 4 million homes short.
Yeah.
We do have per year. We have an inventory problem. We have a very low inventory problem. However, due to current market conditions, because interest rates have risen so fast, so high, so quickly, it has kicked a lot of home buyers to the curb because of uncertainty. Right. I can't afford that. And with the current inflation, a year ago we were at 0% inflation, and now we're, 8.5% inflation. Yeah. So in January, when rates were at 3% on a $300,000 home, and now they're at 7%, that house payment has rose about $500. Right. And when we take the average family of four and we count in inflation, it's costing an average family about $450, $500 more a month. So people are having to dish out another $1,000 a month. Right. And they are uncertain about the election, uncertain about inflation, uncertain about interest rates. But there's a silver lining, because rates should be coming down here very soon over the next 6 months. So I see this spring buying market, and right now it's seasonal too. Right, exactly. Right, we're here in November. That seasonally always is a lower time, but we're starting to see price drops. We are starting to see seller concessions come back. Yeah. Okay, so if a person says, I'm going to wait for rates to come down. Okay, let's look at that. But right now, in a higher rate environment, we also have price drops coming in, right? I had a client here, just got an accepted offer. This house was listed at $705, Okay, 705,000. And they came in, and rates are high, but they went ahead and put an offer in this house, and they got it at 625.
Holy cow.
Okay, that's $80,000 under what they were asking.
Yeah.
Okay. And I said, okay, if we waited till spring and you paid 705 at 7%,
Right.
you know, or let's say rates go down to 5% in the spring, or would you rather have $80,000 off because everybody else has been kicked to the curb because they have uncertainty and they don't want to get into the market in a higher rate environment?
Yeah.
Take the money, take the price drop, marry the home, date the loan, and we'll refinance later.
And even worst case scenario, the rates go up, then you're a genius because now you're sitting at a better rate. Yeah.
You know, and don't worry about the rate. They've been going up and down, forever.
Right.
And actually, rates have been dropping for the last 38 years. Back in 1981, it was 18%, paying 4, 5, 6% discount points.
Right.
They've come down for 38 years, and now they've creeped up because of inflation. And everybody still has that pandemic memory. Mm-hmm. So people who were looking a year ago, 2 years ago, are so used to that 3% rate, and they have their mindset, I'm waiting for rates to drop. I don't know if we're going to see that 3% rate anymore.
Right.
But I do see that we are going to see low 5s and high 4s again here.
Yeah.
You know, in the next year. And right now rates are 7.25. So as soon as we start to see a rate reduction, when they hit 7 or 6 and 7/8, we're going to have a lot of people jumping in the market.
Oh, yeah.
Over the last 30, 40 days, any new home buyers coming in, they weren't thinking about buying a home last year, and they don't even think about interest rates, per my statement a little bit ago, stating, if they weren't thinking about buying a home, they don't even think of rates. But now they're thinking, next year, because everybody just got out of college over the summer, right? And now they got their jobs, and now they're starting to think about buying a home, and they want to enter the market here in 2023. So they're coming to me to get pre-approved, and they say, hey, what's the rates? I said, they're about 7.25%. They said, that's cool. Let's go buy a home.
Right.
Because they don't have that pandemic thought process.
Yeah, which is crazy too, because some of those people that have been waiting through the pandemic, waiting through this, it's like, you didn't pull the trigger then, so what's going to change? You're going to pull it now. It's like what they say, like analysis or paralysis by analysis.
Yep.
Just constantly waiting for this big thing to happen that's never going to happen.
Yep. It's unbelievable. And that's the cost of waiting. Okay. So let's just take let's take a $300,000 purchase. Yeah. Okay. And let's go with Livingston County. Let's assume we don't have these double-digit appreciation like we did, but let's just go with a conservative 5%. So if today that $300,000 home is $300,000, next year at a 5% appreciation, it's going to be $315,000. That means that potential buyer would have to save $1,250 a month after paying his payroll tax just to keep up with appreciation.
Right.
And when I break that out to people, I go, can you save $1,250 a month after taxes? I said, no. I go, so you're wading yourself into the poorhouse.
Yeah.
Is what they're doing if they want home ownership.
Yeah.
If people are, going to move in the next 2 years or they're going to do something, don't go buy a home. Continue to rent, But if you plan on staying in a particular location for more than 2 years, consider home ownership. It's the best thing since sliced bread. Back in 1986, I bought my first home, 10.5% on an FHA loan. And I had bragging rights. I had the lowest rate on the block at that time, And I thought, how in the hell am I going to afford a $343 house payment? Right? Well, that principal and interest, that never changes. But yet inflation drives wages up. Now my cell phone bill is double that.
Right.
Yeah.
Yeah, it's crazy.
Well, almost double that. But but I gained appreciation, and it was great. I remember I bought my second home in 1998, 7 3/8%, Hickory Hill subdivision over in off of M59. We built it, paid $138,000 for a brand new house.
Nice.
Rural development, 0 down, and I had the seller pay for the concessions. I had to actually come to the closing with 10 cents. And I came to the closing, and I tried to give the title agent a dime. He says, sorry, we can't take cash. So we had to write a check for 10 cents, and I couldn't believe it. But so we moved into that home, and we lived there 3 years till the day. and I sold it for $200,000.
Nice.
Right? Walked out with the equity, put that as a down payment on the home I'm currently living in Heartland. You know,
that's incredible.
Best move I ever made. And I didn't know anything. I didn't know nothing about mortgages really at that point, you know, but, and it was funny because when I closed that deal, the mortgage guy, he says, man, you're pretty good at this. You ever need a job, you come and see me, you know? And I was working at General Motors at the time, you know, and I was traveling all over the world, Japan and China and all over. And then they were going to take me to another place across the world. And when I was in Japan, I'd met my wife and I brought her back to America. We got married. And then General Motors comes and says, hey, man, you want a new gig in Australia? Or I believe it was Australia. And I asked my wife, she says, no, man, you know, we got a kid here. You know, I'm pregnant with another one. I don't even hardly speak English, let alone go over with an accent with English, right? And so I called that loan guy and said, hey, man, you know, my wife wants me to stay home, and then I'm thinking about leaving General Motors. How is this mortgage business? Is it easy? And he goes, well, yeah, you know, I think you'll get along just fine. I go, okay. And I quit General Motors, man.
That's wild.
And I went into 100% commission, gave up a pension, gave up a salary, and gave up everything. And I had a new wife, one kid, another one on the way. And we had just built a new house over in Heartland. I thought, oh, my God, what the hell did I do? You know, but...
That's cool though, and I was going to ask you actually how you switched from GM to mortgages, and also, I mean, it goes back to the question about like the people that are waiting. Like, you didn't wait, you know what I mean? You saw the opportunity, you took it. It was scary as hell.
Oh yeah,
you know, it was risky, but you did it, and I mean, obviously, it worked out great.
Yep, everything's a risk, you know. But when you, in hindsight, you look back and go, God, what was I worried about? You know. You know, and I've always learned, you know, we all have trouble through our lives. There's always some situation coming down the pipeline. Right. Or you do something and say, oh, my God, I'm never going to do that again. Right. Or something. But everything seems to work its way out. Yeah. And that's why we get gray hairs or we lose hairs. Right. You know, that's called the wisdom there.
Ear hairs, nose hairs.
Absolutely. But I've been working with a lot of younger home buyers, you know, and of course they're going online and getting all this data and they're trying to drill me with these questions, you know, which and I greatly appreciate that. But we break it down. We start looking, you know, I had a client, just a very young guy and 27 years old, buying a home, and he's at him. I want to put 20% down. I want to do this. And I go, okay, that's fine. I go, and you're the customer. Whatever you want, you know, I'll do. But I need to break this down for you, you know. And as I broke it down on, you know, let's not put 20% down. Let's go with 5% down. Let's go with PMI. You're in a higher rate environment right now. Yeah. Let's keep that money, the extra money in the sidelines, because you yourself said your job was unsecure. You didn't know what was going to happen and all that stuff. So keep that money on the sidelines and then get that first year of home ownership, right? Because the definition of owning a home is no matter where you sit, you can look at something you should be paying for, okay? Because there's either I need new carpet, I need new paint. You know, when you bought the house, you went through an inspection. You spent a couple hours there. Right. Well, I tell you what, why don't you spend the next 6 months to 9 months there and really get to know that home and figure out what you need. So if we put less down, it keeps money in your bank to start making those improvements and have that quality of life about home ownership and doing those little projects on your own and improving your quality of life, you know? And then after 6 months or a year, if you choose, take that money and say, you know what, I got a bunch of money in the bank, I got to get rid of it. Send it to the mortgage company. I guarantee they will take that, you know, and they will lower your principal. Or you can recast, they will lower your principal and re-amortize it over the remaining life of the loan. Right. You know, and so anyway, he wanted 20% down. We're going with 5%. Actually, we're going to 3% down on a conventional loan, and it's just going to work out beautiful for him. Yeah,
and that's the education part, like you were saying, and that's what's huge to me is I actually did mortgages for like a year when I moved here. I worked for Quicken, and the thing is, like, if somebody calls Quicken, they're going to
departmentalize.
Yeah, and immediately go to lowest rate because they're going to try to lock you in. Yep. They don't really even know what they're talking about. They're looking at a computer or they have somebody in their earpiece. Yeah. And they don't go to somebody like you who actually knows from experience and is going to build you a game plan based on your individual desire.
Yeah, you know, and it's funny because I tell a lot of people that, you know, because I get a lot of those deals from those big call centers, right? And And then they go, wow, that was very educated. My other guy wasn't like that. And I go, well, if it wasn't for loan officers like that, I'd be out of a job, wouldn't I? And with the big call centers, it is departmentalized. This guy's going to take the phone call. This guy's going to pull credit. And then it goes down the assembly line, but nobody really breaks in and really educates you. Because most people are looking towards that loan officer to advise them.
Yes.
And so you have these loan officers that maybe, I hate to say this word, more self-serving. Oh, this guy qualifies. Let's just get him this because we could do that now.
Yeah.
But if you break it down and say, you know what, maybe we should look at that credit. Let's improve credit by paying this down, pay that off, make a couple of phone calls here, and let's better your situation here because you say you're not buying for 30, 60 days. Let's improve your situation. Or we might be able to improve that credit to get you out of a FHA or a government type loan that will have private mortgage insurance for the life of the loan, and maybe get you into a conventional loan that is actually you could have a more higher probability of getting an accepted offer, and that private mortgage insurance goes away. And once I sit down and explain those tools, they say, oh, that sounds cool. How do I do it? So now we'll go ahead and break out the big 65 television, and we put it all on the screen. We go into the credit simulators and say, okay, let's knock this balance down here. Let's try this. And all of a sudden the customers say, well, hey, try this. Pay that one down. And what if I close that one? And now they start to discover, oh, my God, my score can go from 660 to 730 immediately. And if we wait 30 days, it can go to 747. And I go, yeah.
And they can see it right in front of them.
They can see it. A lot of times what I'll do with the client is when I pull up the loan origination system and we pull up the debts, right? And then I give the person a calculator, because people actually don't believe how much debts they do have. Okay. And I go, oh, you got student loans? They go, yeah, but they're in forbearance. Okay, great. Well, let's just add them up. Okay. Okay, boom, Mr. Buyer, you got $37,000 in student loan debt, right? They go, yeah, but it's in forbearance. I go, but that's going to be over. As soon as you're out of college, 6 months, those payments are coming in. And I got to count 1% of the outstanding balance on $37,000. That's going to be $370. I don't know, for the next 20 years or whatever it's going to be. They go, Or we'll start adding up all the credit cards, right? We'll say, okay, you got 6, 7 credit cards. Here, let's add up the balances. Boom, 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 right? And all of a sudden, it could be 25. The other day I did one is $57,000 in credit card debt, right? And then I said, and they go, wow, we didn't realize we had that much. And I said, well, you kind of knew. And they go, yeah, we kind of knew, but we can kind of afford it, but we didn't really hit it. I didn't really hit home. So now I said, now let's go over to the next column. Let's take that $57,000 in credit card. And I said, add up these payments. So I started to read off the payments on the minimum payments, 140 here, 200 here, there, boom, boom, boom. So that $57,000 was costing them $1,689 a month.
Crazy.
On those credit cards, right? And now this client wanted to put 20% down on this $600,000 home, and 6 times, that's $120,000. And I said, let's not do that. Let's put 10% down, about $62,000. Let's take the other $62,000, pay off the $56,000 in credit card debt, and free up $1,689 a month. And so they're living in a $300,000 home. Now we're buying a $600,000 home. And as we shuffled around the debt and added up the new debts that they're going to have with a house, car payment, a boat payment, and no credit card payments, it was actually $187 cheaper than their current lifestyle living in a $300,000 home.
Which is nuts.
And they said, oh my God, I never realized that. I go, of course you don't, because no one breaks this down for you. And so they're all in. We're doing 10% down. And of course, his credit was 660, okay? And we're going on a conventional loan. And they're going to get whacked on an interest rate. They're like at 7.5%, and they got to pay three discount points. And I said, well, check this out. Let's do the credit simulator now. So we paid off that $57,000 in credit, and immediately he's going to go to a 742. And then within 11 months, he's going to go to an 808 on his credit. Now he's untouchable. Okay? because right now at that 660 credit score, with inflation rates the way they are, and with the feds raising the prime rate, and the prime rate is credit cards, home equity lines, and car loans, they are just going to bump his interest rates on those credit cards probably to 24%.
Yeah.
The gentleman will never pay these off.
No.
You know, it's just insane. So that's the kind of onion peeling I like to do, is just break it down and have a client discover their own situation.
Right.
How much money do we have to play with? How much equity do you have? And let them determine and design the mortgage with the tools I can help them to discover what cards are on the table so they can determine how they're going to play them.
Yeah, and then they turn the light bulb on.
Yeah, not only light bulbs, it's like stadium lights. You know, it goes on pretty. Because
you're saying, however, it's going to save them $100-something a month from their current situation going into a house that's twice as expensive, but not to mention the thousands upon thousands of dollars in interest they would have paid on the credit cards.
Absolutely. Absolutely. And now that they bought in a higher interest rate environment, prices are low, but as soon as spring season, you know, when spring season starts is January 1st. And plus we're going to anticipate rates coming down, and we know we have low inventory. So we're going to kind of have a repeat of last year where there's going to be, prices are going to start going up because of a lack of inventory. So he put 10% down with PMI. So our plan is within about 6 to 7 months is we will refinance him at the new value after the springtime, you know, raise his values, and we should be able to refinance him, and he should have his 20% equity to get out of PMI, and we lower the rate. And so what we're using this first mortgage is we're going to put a Band-Aid on the situation, right? Fix your credit, get you home ownership, wipe out all that credit card debt until we could put the stitches in for the final loan. And now we will treat that home like a 401k, and now we will only rebalance portfolio once we need to meet another objective.
Yep. I love it.
Very interesting stuff.
Awesome.
I eat it for breakfast, man.
I love it. I love it. I'd always, every time I talk to you, I learn something new. So that's one of the things where I say, like, if somebody needs to learn and understand what their objectives are and how to make it work for their situation, I always say, go talk to Vic or somebody at USA Mortgage, and they'll put you on the right track.
I love it, man. Again, I just eat it for breakfast, man. And I get kind of excited about it.
It shows. I mean, and that's what you want when you're dealing with somebody. I mean, you don't want somebody that's just kind of reading off a computer screen and, okay, we can get you this rate and you need this down.
No, man.
It doesn't work.
You get involved in their lives because, you know, people don't understand their own tools that they have to play with. And when I can help them discover, the world opens up for them, and you get to change people's life, and you not only become their lender, you become their friend and your advocate. And these people call me years and years after, you know, and I'm always there. It's like you yesterday. Hey, Vic, what should I do on this rental property? Well, I would go get a home equity line of credit. And you said, well, Vic, can you hook me up with that? I go, no, we don't do home equity lines of credit. You know, sure, I'd love your business, but I'm going to push you over to this bank here and do that because they should be free, right? And let's create a tool for you to utilize for that down payment, where now I come into the picture and help you structure that transaction.
Which was huge. I mean, I've seen you actually steer people away from you, which I'm like, that right there tells you you're an advisor and not just trying to sell somebody.
That's right, man.
Which is huge. I know we're tight on time here. So I just want to thank you for coming in. If somebody wants to get a hold of you, how do they do that?
They can always go to VictorBales.com or give me a call at 734-417-2115. And I'm always available, man.
You sure are. And also, if somebody wants to learn more from you, you have your own podcast as well, correct?
Yep, that's A Smarter Way Home, and we will be recording tomorrow. We got a very special guest from a title company coming on there tomorrow.
All right. I can't wait to hear it. Great. Well, thanks for coming in, Vic. I appreciate it.
Thanks a lot, everybody. And don't let the market scare you, because we are on the grist here of very good times in the real estate market.
That's right.
Okay.
Thanks, everybody.